Okay, so let's talk about a company that I love that is outpacing its peers. Hi, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. As always, if you're new here, be sure to hit that subscribe button and turn on notifications so you never miss out on my best trading ideas, which I share here each and every week. We're all familiar with the term cloud, right? It's been part of our business vocabulary and personal lives for decades. And all it simply means is it's offsite data storage that's accessed remotely. Right? This was first conceived of all the way back in the 1960s. In 1983, CompuServe began offering customers the ability to upload small amounts of data to its proto cloud. A decade after that, AT&T debuted Persona Link services. This was like the first web-based cloud storage platform. But the cloud storage for business, or the cloud for business, really didn't start taking off until 2006 when Amazon Web Services included, cloud storage. Today, our entire lives weave through the cloud. For instance, whenever you stream a show on Netflix or one on YouTube, that's using the cloud. Same for everything from that you post on, Facebook, Twitter, Snap, whatever. Not to mention your company and all the data it requires to conduct its business. This year, global cloud spending is projected to top $400 billion. And by 2027, it will grow to more than $552 billion. That represents a 1,990% increase from where the market was just in 2012. But what's most often lost in translation is the complexities required for all of this to exist. Each time you go to stream a movie or purchase something from a website,
3 words for you: treat yourself. Treat yourself 2011.
There are tens of thousands of servers and applications, helping companies complete that task. Not to mention, all of that needs to be safe and secure, right? So this tangible and intangible infrastructure stretches across, multiple providers and multiple platforms. That requires its own unique tangled web of security, one that can monitor data, detect anomalies, and intercept threats across, all of these intricate complexities that are the cloud. In turn, the need for log monitoring, artificial intelligence of AIT operations or AI ops, and overall cloud observability has been born. With the surge in working from home and less reliance on a physical office presence, right, this is booming in demand. Over the next 5 years, the cloud observability market will grow 39.5% to $53 billion. And though this sector is given rise to an increasing number of important names, as well as current and sort of future S&P 500 components, there's one company I think really stands out from the rest and is actually the leader of this pack. DataDog, ticker symbol DDOG, is one of the pioneers of cloud observability and DevOps, providing monitoring and other security products for businesses. Of course, if you're an old Cowboy Bebop fan, you gotta like DataDog. All right, so the company is now a clear leader in this sector with a market cap of more than $50 billion. But in 2010, there were a lot of questions if a New York-based, cloud infrastructure startup could run with the big dog, so to speak. So DataDog was formed by a developer and an operations team manager, right? Developers are the code writers for applications, operations, build servers. These two groups need to work together, but as is often the case, they tend to hate one another, right? So these two sought to create a system that brought both sides together. Well, turns out the entire industry was looking for the same thing. And the DevOps movement that began then helped facilitate, right, this mass migration to the cloud that has followed. So over the years, DataDog has evolved from a single product to an entire platform. It works with AWS, Google Cloud, Microsoft Azure, Alibaba Cloud, VMware, and private clouds. It offers more than 450 integrations, and that's led to more customers turning to DataDog. In the fourth quarter, revenue jumped 84% to $326 million. What's important here is that over the last several quarters, we've seen the company's revenue growth continue to accelerate. I'm talking from 56% back in the fourth quarter of 2020 to 84% in the fourth quarter of 2021. Its number of large customers with annual recurring revenue of more than $1 million, which is very, very important, grew from 101 a year ago to 216 in this fourth quarter. On top of that, DataDog has positive free cash flow, and more importantly, it is profitable, something that competitors like Elastic, New Relic, and Splunk, they can't say. For 2022, the company is forecasting revenue growth of 48%, which was well above the 36% Wall Street was expecting. And that's why we saw this huge, massive jump in DataDog shares recently. Now, they got beat down during the tech sell-off that we had in January, but they have started to rebound very strong from these lows that we saw right there at the end of January around that $125 level. So DataDog is a pioneer in the DevOps and cloud observability market. It continues to evolve and shape the industry, and I believe it's only a matter of time before it replaces some sort of fading star and joins the S&P 500. And for all those reasons, I think that's what makes it a perfect fit for every growth investor's portfolio. Well, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. For more information like this, be sure to go down to the description and sign up for my free e-letter. Until next time, here's the high returns.